There is a lot of debate on the internet about the big beautiful bill. On one side, people claim that it is going to lead to economic prosperity. On the other side, some experts are warning that it will lead to a financial disaster. What we know for a fact is that it is going to be the largest tax cuts in the history of America since Ronald Reagan. Now, it doesn't matter what you think about this bill now, whether you support it or you hate it. It was passed by the Senate and signed by the president, which means that everybody is going to be impacted. So here in this video, let's try to figure out whether it is going to lead to an economic boom or it will turn into a financial disaster and how you can profit out of it. If you're ready, give this video a thumbs up and let's get right into it. The big beautiful bill contains a lot of things within itself, but one of the most important things is that it will make 2017 Trump's tax cuts permanent. They're supposed to expire this year, but from now onwards, America is going to be on a trajectory of low taxes, both for individuals and corporations. It is also going to raise the SALT from $10,000 to $20,000. That will allow people who are making a lot of money to further lower down their taxable income, which means lower taxes. It's also going to lower down the long-term capital gain taxes from 20% to 15%. There were already multiple ways where you could lower down your capital gain tax, but now you know for a fact that you're not going to pay 20%. If you're selling off your stocks, you will pay much lower taxes. This is probably one of the lowest taxes that you can possibly pay on an investment. And that's why rich people primarily make their money from stocks and investments. Now they will pay even less taxes. If you are a billionaire or if you are even a millionaire with millions of dollars in stocks and you're selling your stocks, you will pay a lower tax rate. On the other side, it is going to cut $900 billion from Medicaid. This is one of the most important government programs, and they will make it much more stricter, much more difficult for people to be eligible for Medicaid, which means that cutting government programs. But besides that, they will also get rid of the clean energy subsidies that's worth around $515 billion. Back when Biden was president, he passed the Inflation Reduction Act to be able to compete with China, to set the US clean energy on a trajectory to compete with China, since China dominates the battery market, the clean energy market, and EV market. With these subsidies, it's supposed to catapult Tesla and other EV car companies and battery manufacturers to finally be able to compete with them. On top of that, it's supposed to eliminate multiple government agencies that's supposed to save the government around $800 billion. For example, food stamps will be reduced by $180 billion. The Department of Education is entirely eliminated. That also costs the government billions of dollars annually. On top of that, eliminate almost all foreign aid to other countries. But the biggest claim out of this big beautiful bill is that it's supposed to grow the GDP by 4.6% to 4.9% within the next 4 years. And then it will slow down to around 2.8% after that until 2034. If these objectives are going to be met, the United States debt to GDP ratio will fall in the best case scenario to 94%. Currently, it's around 100%. That's if you do not include intragovernmental debt, the government debt that one government agencies owe to another. Because if you also include intragovernmental debt, then we are talking about 120%. And with the current rate, they're supposed to grow not to 117%, but up to 135% within the next 10 years. But this is a very bold claim that with this bill, it will be lowered down to 94%. And this is, by the way, the charts from the White House page. The next biggest claim is that they will lower down the primary deficit and will turn it into a positive, which is a big claim. The primary deficit is the entire deficit if you exclude the interest payments, because interest payments play a big role. And interest payments also depends on multiple factors, such as the rates that are set by the Fed. We can't predict the rates that the Fed will set in the next couple of months, leave alone predicting them in the next 5 to 7 years. If interest rates will be low, then interest payments will be low. If interest rates will be risen to 5 or 6% like they are right now, then the interest payments will take a bigger chunk of the government's revenue. Nonetheless, the next biggest claim that they have made is that under the Big Beautiful Bill, the total deficit compared to the GDP will go down from around 6% to as low as 3.2%. And 3% is the sustainable level. It's not the ideal target because you want to bring it down to lower than 3%, but it's far better than 6.3% that we have it right now. But if we are going to be honest about it, then according to multiple experts, this year it is going to be more than 7%, since it is going to cut a lot of government's revenue, which will force the government to borrow far more money, which is going to grow the deficit. All of this sounds great and fantastic. This is exactly what the United States needs. Finally, the debt problem will be achieved. But there is one problem with it, and that's because it was created by the Council of Economic Advisory, which is an agency within the White House, and they work directly with the President of the United States. So they came up with the most optimistic numbers possible. Growing the GDP by almost 5% annually is unrealistic. We can't even figure out whether China will grow by 5%, which is 5 times much poorer than the United States, leave alone for the US to grow that much. The US economy is a very matured economy. It has reached the levels that it's very difficult for it to grow by more than 2.5%. So it doesn't matter how much you cut taxes. Expecting it to grow by 5% is only possible in theory. The most realistic scenario is for it to grow by around 2%. In fact, without the Big Beautiful Bill, it's supposed to grow by less than 2%. Let's assume that you pass the Big Beautiful Bill and is going to encourage much more spending, and the GDP will grow by more than 2%. You can expect 2.2%, 2.3%, in the best case scenario, maybe 2.5%. But 5% in a single year is insane, and 4 more straight years is extremely unimaginable for most people. Let's take an example of 2017, when first Trump's tax cuts went into effect. The GDP did actually grow faster by around 3%. Again, that is not 5%, that's just 3%. And the circumstances of the economy back in the days was completely different from today. Back in the days, we had very low interest rates, we had very low inflation for multiple years, and the deficit to GDP ratio was around 3%. Today, we have a completely different reality. Deficit is more than 6%, inflation just cooled down to around 2.3%, and interest rates are almost 5%. So expecting today anything around 3% to 5% is impossible, especially when we talk about 4 straight years. Here is the most realistic scenario that is going to happen. All we have to do is look back at the history and find out what exactly has happened when we cut taxes by a lot. The biggest tax cut in the history of America was probably by Ronald Reagan back in 1981. He becomes the president, he comes from the private sector and realizes that the United States individual taxes are as high as 90% for the highest earners. Corporate taxes is about 50%. Who is going to work hard to make more money? You have to lower those taxes. So he brought them down from as high as 90% to as low as 28%. And he also lowered down the income tax as well for every single individual and for corporations as well. It instantly resulted in a much higher deficit to GDP ratio of about 5.7%. It stabilized after that. Now, the interesting thing about this chart is that in 1986, at this particular point, you see a very different trend where the deficit began to shrink. And that's because when the government realized that on one side, we are still spending the exact same amount of money, we still have a huge military, we still have the exact same government programs, we still have all of the spendings. On the other side, we cut taxes, which dry up our budget. So investors started to freak out. Especially during those days, the interest rates were extremely high. So the Congress was forced to pass the Gramm-Rudman Act. The point was it was very simple, that if the Congress will not agree to balance the budget, there will be automatic cuts on discretionary spending, and that includes the military and the non-military. In fact, Warren Buffett proposed once upon a time a very similar idea, that if the Congress is not going to balance the budget, then not a single person can run for a re-election, and they will instantly fix the problem. So it was very similar to that. The second example is, of course, 2017 tax cuts by Donald Trump. When he took office, the deficit to GDP ratio was around 3.4%. He passes one of the largest tax cuts in the history of America, and by 2019, the deficit to GDP ratio has grown to 4.6%. And that's normal because you will incur some kind of a deficit in the next few years because you just drive up your budget. On the other side, over the long run, it's supposed to create much bigger economic growth, which will pay for the tax cuts in the first place. So the real question is that, how is that going to impact you? That is the question that you want to find out. And how is it going to impact the overall economy? First of all, United States is no longer going back to the period of high taxes. Going back to taxes where the individual taxes would be as high as 70 or 80%, or corporate taxes will be as high as 45 to 50% is not happening at all. Because the rest of the world has lowered down their taxes over the last 50 years, which means that if you hike the taxes for corporations in the US, it is going to create a lot of trouble for them, which is going to force them to leave the United States to other countries that have much lower tax rates. Secondly, if you hike the taxes for the individuals and not the corporations, it is going to create a lot of social instability, which is why forget about the era of high taxes in the US. And that means that there will be a lot of spending cuts. The government from now onwards will try to cut more and more government spendings. And it doesn't matter who is going to be in power. Republicans, Democrats, because there is no other way around it. Less taxes is going to lead to much more spending, which is going to grow asset prices. When people pay less taxes, they have more money in their pockets, which means they will spend more money, which is going to grow GDP much faster. But it is also going to lead to a much higher asset prices, both real estate and the stock market. I don't think real estate will be impacted much because the job of the Fed right now is to sell most of its mortgage-backed securities to stabilize the housing market so that it grows by 2 to 3% annually. Since majority of the houses right now is being financed by the Fed and it's unsustainable in the long run. I've explained that in one of the previous videos, which you can actually watch, but overall, that is probably the reason why house prices won't grow much. So the only asset class that will grow dramatically over the next few years because of this bill is most likely going to be the stock market. And finally, if the GDP is not going to grow by 4.6% to 4.9% like the White House is promising right now, then more government cuts are coming for a fact. It's very easy to claim that the GDP will grow by 4.6%, but you have already cut taxes, which means that you drop your budget. So if you're not going to make more revenue from a bigger economy, you will rely more on debt. Now, there are two ways for the governments to raise money. For one side, they can do it from the public sector, which means from investors. But there is a lot of concern about the debt that the US has, which means that it will be very, very difficult. The second way to raise income for the government or to raise money is from the Fed. But every time the deficit grows and you raise money from the Fed, it means an increase in the money supply, which again is going to lead to much bigger inflation. Now, you might not feel that inflation because they have a specific way to calculate inflation. The real inflation, you will see it, is by looking at asset prices, especially the stock market. Yes, some stocks do actually grow because they innovate new technologies, but a lot of times the stocks actually grow because there is too much money in the economy or too much printing of money. So the only way to protect yourself if we are not going to hit the 4.6 GDP growth within the next couple of years is to make sure that a portion of your money is invested in the right assets that will grow alongside inflation. Because frankly speaking, I don't think there is anybody except the White House who believes that the economy will grow by about 5% within the next 4 years. That's it for today, guys. Thanks for watching, and I will see you in the next one.